Welcome to the Deep Impact Investing Podcast with Kimberly Griego-Kiel on behalf of Horizon Sustainable Financial Services. In this podcast, I discuss sustainable impact investing, how to create portfolios that match your values, and a variety of other topics such as financial education, environmental sustainability, social justice, and sustainable food systems. Do you want to know if your investments seek the kind of accountability from corporations that you demand? Listen in as I explore the burning question, are you investing like you give a damn?
Hello and welcome to Deep Impact Investing with Kimberly Griego-Kiel from Horizon Sustainable Financial Services. Kim, how are you?
I'm doing great. We have a wonderful, I guess I'll call him a guest because he hasn't been on for a while.
Super famous guest.
Super famous guy.
Yes.
It's Johann Klaassen joining us today.
Hooray.
Yay, Johann.
Welcome back.
Yeah.
Yay, thank you.
I said it already, but it's true. I miss your face.
Well, thank you.
Yeah.
And I yours.
This is like a big group hug. This is fantastic.
I know.
Oh.
It is. It's I'm living far away now, and I do miss the face of Johann. So anyway,
It's been a couple months.
I know it has. But anyway, let's get into this conversation. We are going to talk about what happened in the markets last year.
Yep.
It was a crazy year, wasn't it, Johann?
It was very weird, very strange. Yeah, definitely.
We finally got that year that I had been saying to clients for so long, the market's been up for a while. We could have a pretty good down year soon. I felt
Pretty
like
good.
a broken record.
A good down year.
Yeah.
Well, we do need those to reset periodically so that things don't get too far out of whack. But I don't think anybody is happy about it. Nobody I've talked to recently has been excited to have had that prediction come true, right?
Right. I know. I just like people to be ready for when it happens. And I don't really like it either. One, for the client accounts at Horizons and my personal accounts. It's not so fun.
Mm-hmm.
I get it.
Mm-hmm. Right.
So, Johann, I know when you and I were talking about this, you said that there are 4 things that happened in the markets in 2022 that you wanted to address.
Oh, well, sure. Do
you want to start with an overview, maybe?
Yeah, well, I think the place to start is probably with the overview. Yeah, the markets were down. Everything was down. Almost everything was down, I should say. Right. We had the S&P 500, which is what most of us use to talk about the United States stock market in general. That was down. Once we include all the dividends and all that kind of fun stuff, just over 18% down for the year.
Okay.
So that's kind of a lot. The broader market indexes, the Russell 3000, which is kind of everything in the stock market, in the US stock market, that was down a little more than 19%. Same kind of deal. The bond market, the bonds were down as well, which is weird.
That is surprising, isn't it?
Yeah, the intermediate bonds were down 9.5% for the year, the Bloomberg Barclay US aggregate. And it's if we looked at the 30-year US Treasuries, the long bonds, those were down even a lot more.
So that's something that people don't always expect. I've heard this before. When the market's down, bonds will be up. But that's not always true. And this is the second significant time in my 25-year history in this business that I've seen this happen.
Yeah, it is unusual. In ordinary circumstances, if stocks are down, then bonds are at least flat, not going anywhere, sometimes even up. But this time, that's just not what happened. And I think that's because the thing that prompted all of this was the Federal Reserve trying to get a handle on inflation.
Right.
So they raise interest rates, and when interest rates go up, the value of bonds goes down. And the longer the bond, till maturity, the more of an impact it has on the value of the bond. So shorter term bonds are down less, and longer term bonds are down a lot.
I'm really glad you explained that, because I think a lot of people forget or don't know that there's that inverse relationship. And they think, well, interest rates are up. Why are my bonds down? But it's that inverse relationship that happens.
Right. Well, if Johann Incorporated were to issue a bond today, or a year ago, at say 5%, and the market around me suddenly, the interest rates start to rise, and the interest rates go up to 10% for similar bonds. Well, nobody's going to want to buy my Johann Inc. bond at 5%. They're going to want me to give them a discount on the price. So to the point where it amounts to the same thing as having a 10% bond. Yeah. So it makes sense when you think about it in those terms, but yeah, it is a little weird. Not that I'm issuing any bonds in Johann Incorporated.
Right. I was just thinking, wow, can I actually buy shares of Johann?
Not today, not for sale. No.
Okay, great. Excellent. Moving on.
Yeah, so just about everything is down. And I have to say just about everything, because not everything was down for 2022. I was watching, well, one of the market report shows in the last week of December. And they were talking about how there were 4 parts of the market that were up actually for 2022. And they said, so the 4 parts in inverse order. So
let's keep that inverse thing happening.
The 4th best thing was the US dollar. So as currency speculating the US dollar against other kinds of currencies, the US dollar was up a lot. Now, our clients didn't benefit from that because we don't do any currency speculation in their accounts.
Right, unless they're traveling overseas and exchanging.
That's not me doing that, though.
No.
That's the exchange rates folks at their credit card companies, probably. So the 3rd best part of the market was commodities. So things like copper and oil, I guess, and other industrial metals and
gold, that kind of thing.
Things. Yeah. Mm-hmm. That was up a lot this year, but again, our clients don't participate in that because copper and oil and so on there really isn't currently a good environmentally sustainable way to get that stuff out of the ground.
Yeah, the extraction piece is just horrendous.
Yeah, we tend to avoid that part of the market. And there's also, one of the main ways that people get at commodities is, again, with futures and all kinds of derivative contracts. And that's, again, highly speculative, and we don't want to mess with that.
Right.
So
Horizons just doesn't do those types of things. It takes a very specialized, person to really understand that and be able to trade in those areas. So
exactly. Yeah. So let's see. So the 2nd best part of the marketplace for 2022 was military contractors.
Boo.
Yeah, those don't show up in our portfolios either.
I'm pretty sure that 99.9% of Horizons clients are happy about that.
Yeah, I think so too. And the very best part of the market for 2022 was oil and gas companies.
Also a boo.
And again, we end up having maybe 1 or 2 of the smaller oil and gas companies in our portfolios here and there, when the model managers or the mutual fund managers think there's an opportunity to do some shareholder advocacy and talk to those companies and get them to clean up their act a little bit while they're doing their dirty business. But
it's a tough road.
Yeah. And so, the clients that we have who have a zero carbon energy policy in place for their accounts would not have benefited from it, even those tiny little pieces. So the 4 best parts of the marketplace for 2022 are all things that our clients didn't get to participate in. And to some extent, the reason we didn't participate in those with our clients is because they didn't want us to, like military contractors and oil and gas. And also because it's difficult, if not impossible, and highly speculative to do the other things in anything like a reasonable way. So
it all makes sense.
yeah, but unfortunately, it means that our client accounts are a little bit behind the benchmarks for the year.
Yeah. Yeah. Well, I think that makes sense. And, if we're letting those folks know, letting clients know
Mm-hmm.
that that's the case, most of them are okay with
Yeah.
that. Yeah.
Yeah. And at the same time, the one important thing that I've been able to talk with clients about recently is that when we look at the actual performance, especially clients who've been with us for a while,
Yeah.
we can go back for a 10-year time frame and say, look, when we set up your account 10 years ago, we thought it was going to get 4.5%. And now here we are 10 years later, and the average annual return has been 4.5%. Look at that. Hey,
ding, ding, ding.
we hit the target.
Right.
And then talking to them about why that is, that, our 10-year expectations, our long-term expectations were set with the understanding that we get one of these bear market nastinesses about once a decade.
Right.
And so understanding that was likely to happen once in a 10-year period, we got one. This one's a little late, the
Right.
last one was 2008, 2009. So it was a little late arriving, but here it is.
Here it is. Can I ask you a question, Johann? You mentioned that, when you were talking to this client or several clients, you said,
Mm-hmm.
When we opened your accounts, the expectation of return was X percentage. And tell the listeners how you come up with that data, with that percentage estimate.
Ooh,
guesstimate. Magic.
Oh, no, it's my crystal ball. No.
No, the magic 8-ball.
Yeah, exactly. Yeah. No, there are a handful of data suppliers out there who do a really good job of cross-comparing past performance and past performance trends with current economic conditions. And those folks go back, they take the last 100 years worth of performance data and look at the patterns that they find in there. And they look at the performance probabilities for each separate asset class. So big companies in the United States, small companies in the United States, European companies, Asian companies, all of that, and then bonds too, government bonds and corporate bonds and everything. They compare all of those things and come up with different numbers for each of them. Then I go through and put all of those numbers back together. I take the data, those numbers from several different sources, and I crunch them back together, giving them different weightings based on how
portfolios.
based on how good they've been in the past.
Yeah. Well, yeah. It's the only way we know how to do it.
Right. The folks who've had a better track record of making those kind of predictions in the past, I'm going to listen to their voices a little more closely. So I reweight all of those and then crunch them through in a big ugly spreadsheet.
Ooh, sounds fun.
Always.
Yeah.
I love a good spreadsheet.
I know you do.
And then we put those together, and then we add those into our investment policy statements, which we provide to every client on their way in not on their way in the door, but after we've had a chance to chat with them a little bit about who they are and what they're up to.
Right. And also updating that investment policy statement on a regular basis, right? Mm-hmm. Yeah. It's been interesting watching those numbers change over the 25 years, 22 years that you and I have known each other.
Yeah.
And you've been doing this. So 20 years ago, almost 20 years ago, that average annual return was a bit higher.
Yeah. Well, the expectations were higher coming out of the 90s. Everybody's expectations were sort of warped, maybe is the right way to put it, by the wonderful, marvelous returns of the late 90s. And then we had the dot-com bust. So yeah, I remember when we were first starting, well, when I was first starting with, a previous firm, um, the thinking at that time, in 2001 was that an all stock portfolio should get about 12% per year. Now we're not thinking anything
Wow.
like that now, no.
No.
But that was
Those were
based
the
on,
days. Yeah. Late
right.
90s. It was crazy.
Yeah, it was weird. But that seemed like, if anything, people were saying, well, why should I give you my money if it's only going to earn 12%? Why don't I just go down the street here and open an account at whatever the discount brokerage was at the time, and load myself up with internet stocks, the
Well,
dot-com boom,
because it was going to be a painful ride down. And
Right.
yeah, I remember when back in the day when I was working with Richard Barr,
Mhm.
and he had a few clients who really wanted him to put them all in technology, which was
Mhm.
booming there in the late 90s. And
Right.
he said no. And I would guess maybe 10% of those people who asked, because actually a lot of people asked, left.
Mm.
That's fine. And the
Yeah.
rest understood the principles of balancing your portfolio with several asset
Diversification.
classes. Yes, diversification, and understanding that the markets are going to go down as well. And they don't always go up 20-25%.
Right. Well, just before just before I started in the SRI world, in the sustainable investing, I was working for a big mutual fund company, and part of my job was to talk to the little old ladies who would call in, and they were trying to get themselves out of those technology funds because they were worried.
Mm.
And they had enjoyed the 100, 150, 200% per year growth over those last couple of years in the 90s, right? But they were getting worried that things were getting a little weird, and it was part of my job to talk them into staying.
Oh,
Now uh, I was unfortunately kind of good at it too. But
oh,
that was a not inconsequential part of why I started looking for. I've heard of this thing called ethical investing. I wonder if it's possible to do that really here in Colorado.
and
So
it
yeah,
was. Yeah,
and
you
it
made the
was, yeah.
transition, which is great. And it's funny you say that you were very good at it, because I know the clients that you talk to feel very comfortable with you
Well, good.
and they like you. So it's
I'm
great,
glad.
right?
Yeah, yeah. Well, at the one of the things about one other note about that and about diversification, the at the very peak of the Nasdaq and the tech stock boom, 80%. I remember reading this statistic. 80% of all new money going into the market at that time was going into those technology funds, those dot-com stocks. 80%, right at the peak. And then, of
Yeah.
course, over the next 9 to 12 months, those companies that didn't go bankrupt then dropped by 80% in value. Right.
Yeah. Isn't
So
that it's amazing. So that there's a lesson there.
yeah.
Don't jump in when everything's been up for a
Mhm.
while.
Yeah. Well, and,
In
and
that,
be careful, right? It's
yeah.
the and keep yourself diversified. We know that if we try and follow that hot dot, right? If we're trying to buy into the thing that's doing the best, oil and gas stocks right now.
Right.
um,
I want to talk about that for a minute,
sure.
because the companies are doing well, these big companies, but I've also noticed a drop in gas prices
Uh-huh.
at the same time. And also at the same time, it is almost impossible to find a newer hybrid vehicle.
Hmm.
Interestingly enough. So I'm trying to buy one.
Oh,
Um,
yeah. The
and
the used car market, even the new car market has been very strange in the last couple of years too. Yeah.
yeah, and nobody has had the one that I want.
Hmm.
Um, but I was able to put my name on one that isn't even in production yet.
Oh, cool.
right? So it's hard to get those hybrid, or I would assume electric vehicles too right
Yeah.
now.
Well, one thing that I wanted to mention too about where the market is right now, right, is that yes, oil and gas companies are at the top of the list, top of the leaderboard for 2022. And if we look at, I pulled up the numbers on this actually, the S&P Global 1200 Energy Index, which is all the energy companies, pretty much all the energy companies in the world, carbon energy. For 2022, those companies were up 48.5%.
Oh my gosh.
Right?
Not the 200% of the 90s, but
No, but
it's
when
still
everything else is down
significant.
20, that's still something pretty, yeah, that's pretty good.
Right?
The Global Clean Energy Index, also from S&P, Standard and Poor's, was down 4.75%.
Oh,
So it's
that's
like
not too bad.
that's a 55% difference though, right?
Yes, it is. Yes.
But when we look a little further out, if we look at a 5-year average, the carbon energy index is up 7.3%, which that's nice. That's pretty good.
It is.
But the clean energy index is up 18.7.
Ah,
So
and what's the time period on that again?
that's 5 years average.
5 years. Okay.
5-year average. So, our clients are for the most part not participating in any of those oil and gas companies. But they
But
are
long
participating
term,
with the global clean energy, right?
yeah.
And so it's a small portion of the portfolio, but 11% per year on average over a 5-year period. That's that's worth thinking about. Now,
Right.
past performance is no guarantee of future, etc. But
Right.
but for our clients who have been in that part of in the clean energy market, yes, we're behind right now, but that's a short-term thing, and the long-term trend has been definitely wind at our backs.
Yes. Well, we want more wind energy companies, so that's perfect.
There we go. Right.
Yeah. So I know you don't like to give projections or, pull out the crystal ball, which, I heard fell off the counter and broke. But
Yeah.
tell me what your expectations might be for this year, for 2023.
Yeah, I've been listening to, well, it's the time of year when all of the economists make their predictions for what's going to be going on this year.
Right. And you've
Um,
listened to every single one of them or read every
oh
single
yes,
one, right?
absolutely.
Yeah.
No,
All
of
of them,
course
so that
not.
you can put that data in a spreadsheet and then come up with a prediction, right?
Right. No.
No.
But the handful that I do listen to and pay the most attention to they're the folks who say, well, on the one hand and on the other hand. So, they're very careful to lay out all sides of all arguments, which I love because, that's what I want to hear. I want to hear what they think the most important factors and why we want to weight them differently, why we want to pay particular attention to this one and why we don't want to pay particular attention to that. So those folks who are, they're taking the time to look at all the different factors and tell us about them. Those folks right now are pointing out a couple of things. One is that almost all of the big companies in the United States are preparing right now for some kind of a recession in 2023. So there's big job cuts being announced, and there's they're doing layoffs, and they're trying to clean up their balance sheets, and they're doing this and they're doing that in preparation for a recession. Now, one of the things that might do is it might actually prevent the recession.
Oh, that would be interesting.
If they get out ahead of it far enough, it could, well, it might not prevent it completely, but it might make it a very short, shallow, not very bad recession.
Well, we'll take that if that's the case.
I would be hip to that. Yeah,
Yeah.
that would be
Yeah.
just fine by me.
Yeah.
And so the sort of, I don't want to say consensus, but the folks that I listen to most closely are suggesting that there is probably a recession coming this year, but it's likely to be not too bad considering. And then the engine of economic growth should kick right back into gear, and we should move forward into the second half of the year or into 2024 with some good growth prospects.
That sounds great to me. And everybody's talking recession, and we haven't had one for a while. So
yeah, I hesitate to be too optimistic. I tend to be an optimistic guy just generally.
Right.
And so I don't want to be overly optimistic, but I do have, I think we're in a pretty good spot.
That sounds great. We'll take it. Yeah, I like that. I want to ask you another question. That you and I had a conversation a few weeks ago, and you made a statement that I thought, okay, that
Right.
is such a great concept and way to look at things. So I'm going to repeat what you said, or what I remember you said. You told me that, or you were talking to a client, or I don't remember how it came up, but all investments are future oriented. Now, we do talk with people about looking at the long term, but even someone who has money in short-term bonds, it's still future oriented. So explain what you meant by that.
Yeah, well, so there's another, I just read this one to another client recently who was on the phone. Gil Weinrich of Seeking Alpha wrote not that long ago, the surplus one spends in retirement stems from the restraint shown pre-retirement, which is the sum and substance of the discipline offered by financial advisors. Right.
Ooh,
so
very good.
The money I don't spend today is the money I'm going to get to spend when I'm retired, when I'm not earning. Now, so that's what financial planning is in some respects, is on the one hand, how can I save more today and invest it wisely so that I'll have it available for me tomorrow, or in some extended sense of tomorrow, have it available on down the road. And then, if it falls short, what am I going to do? How am I going to adjust my expectations, or can I save more, or, how can I adjust? So yeah, all investing is in some respects future oriented, right? That we put money in we buy a bond with the promise that they will pay us back the principal that we gave that we spent, and some interest along the way. Or we buy a stock, and what we're buying in some respects is a claim on the future cash flows, right? The future profits from that company.
Exactly.
Or maybe the idea that somebody else will buy it from us at a higher price.
Well, that I think is also the goal.
Yeah, well, but that's a more speculative sense of
right. It's not what we're talking about here.
Yeah, that's the casino sense of investing.
Right.
But so we're buying shares of a company because we think that somewhere down the road, somewhere in the future, they're going to have profits that they'll be able to share with us. But interestingly, sustainable investment, like we've been doing for a couple decades now each, is even more future oriented than ordinary run-of-the-mill investing, right?
I would love for you to tell us how that works in sustainable investing and how that is affecting your clients at Horizons.
Right. Well, so every investor is investing for the future. But if an investor isn't looking at the impact that their investments are having on issues of social justice or environmental sustainability, they're investing kind of blindly in some respects, right? That they're just investing in whatever seems like it's going to be a good idea. But as sustainable investors, we're explicitly trying to invest not just for a future, but for a better future, right? A future that is, that's better for people, it's better for the planet.
It's going to be there still for the younger generations.
Right. Yeah. So, in some respects, sure, we could have at the beginning of January, bought a whole bunch of carbon energy companies and increased our portfolio by almost half. But in the process, we would have been contributing to or profiting from
the destruction of the planet.
Yeah, the destruction of the planet.
Yeah.
And we don't want to do that.
No.
It doesn't make sense to invest today for a tomorrow that won't exist.
Say that again.
It doesn't make sense to invest today for a tomorrow that won't exist. Yeah,
I just really wanted to emphasize that point because that's what you're doing. That's what's so important there. Yeah. And before I forget, I want to mention, if listeners are interested in looking at their portfolios and seeing if they have a lot of oil and gas or weapons, production in there, and maybe divest from those things, I know Johann really wants to talk to you about that. So you can reach him two different ways. You can call 505-982-9661 or email him at info at horizonssfs.com, and he'll get back to you and let you know what you can do with your personal portfolio.
It's interesting when the markets get wacky like this. We hear a lot of from new clients, from new people calling us to say, my old investment advisor has always told me that sustainable investing is just a great way to lose money. And well, he lost money this year. So why not? Why not make a change? Why not go ahead and make a change to sustainable investments? And then we're able to tell them, hey, look, right now, everything is down. But over the longer time period, sustainable investments keep up with the plain vanilla basic benchmarks, if not maybe exceed them over longer time.
Just a little bit, but it does.
Just a little.
Yeah. Have you noticed anybody who's called you? I'm just throwing this question out there, so if you don't want to answer it right now, that's fine. But have you noticed from anyone who's called questions around the ESG pushback that's happening?
Oh, have I heard any questions about the ESG pushback? Not really. I have heard a couple of people ask questions, something like, how do we know that that Horizons is not just part of this greenwashing thing?
Oh, that's a great question.
That's about as close as we get to it, so they've heard that greenwashing is a thing.
Right.
And they want to know how serious we are about it. And well, to be able to say, well, we've been doing it for more than 20 years. I have a PhD in ethics. And we have been working with with the leaders in this industry for 20 years. And we know which firms are doing a good job and taking it seriously and which ones are pretending.
Right. It's a process that you research diligently on a regular basis, and making sure that these companies we're using, the mutual funds or the managers, are really also doing what they say they're going to be doing.
Yeah, I had a conversation with a mutual fund manager. They were desperately wanted to get us to use their fund. It was one of these that had been recently rebranded as an ESG fund. And so I was on a Zoom call with one of the portfolio managers and somebody from their sustainability team. And I said, okay, well, this is all very good. I read your presentation, so you don't need to read it to me.
Right.
But what kind of impact does your ESG criteria make on your actual security selection in your portfolio? How much of a difference does it make? Can you show me some examples? And it was a Zoom call, so there was just some blank stares of,
what do you mean?
Well, and that was enough. I said, okay, that's good. I don't need to hear anything more. If you don't have an answer right away,
Right.
then I know a lot. That tells me immense amounts about how seriously you're actually taking this, which is to say, not at all. So, but yeah, that moment of hesitation of, wait, what? How does it impact the portfolio selection? Well, that was enough to tell me that
Right.
I didn't need to.
We don't really know how that happens. We just guess. That doesn't work.
Well, and some of the bigger companies that have been touting their ESG credentials over the last couple of years have started getting big multi-million-dollar fines from the SEC for deceptive advertising, among other things. So,
and I'm happy to see that, and I understand that it is part of this national pushback that we're seeing from a certain group of people, and I don't want to be naming names, but it's actually probably good for us in this industry long term to be able to say, hey, we're not greenwashing. We are serious about this. Mm-hmm. Those people over there might be greenwashing, but we are not. And being able to show that, I think, is great. Yep. Well, I'm gonna start calling you Dr. Johann.
Dr.
Johann. So, Dr. Johann, is there anything else you want to mention about 2022, 2023 before we wrap up?
Well, other than that, we miss you desperately.
Oh,
we wish you were here. Well, no, it seems like you're doing pretty well in Oregon.
It's all right. Yeah.
Back in the old homeland.
Yeah.
I think that we're doing pretty well. The clients that we've been talking to have been really calm. I think we've done a good job over the last few years of letting people know, that a bad year is coming. It's just a matter of when, not if. Right. And so most of them have been prepared for several years with the understanding that this was coming. And so, I think we did a good job with that of making sure that they were ready. And so, but I think that now that we have come down a bit, the market is reset. Not that it can't go down again from here.
Right.
It could, knock on wood, and it won't.
Yeah.
But, we could see some more down periods here in this coming year. I think, another volatile year is not unlikely. But I'm hopeful that from this low point, the market will have a handful of nice, strong years ahead of us, and that the next few years will be nicely profitable for ourselves and for our clients.
That sounds great. I like it. Yeah.
Doesn't it?
Yeah. Keep working on that. Well, Johann, Dr. Johann. You could start your own podcast, the Dr. Johann Show.
No.
No? Okay. Well, thank you so much for hanging out with me and talking about all of this. And it's fun. I miss having these conversations with you on a regular basis. Eric, water cooler talks. Eric, is there anything you want to ask about this?
Well, I'll tell you what, I can tell you from previous conversations, Johann is a brewmeister in some fashion. Right?
Yes.
Yes. So I think it's a beer with your bro, Dr. Yo podcast.
Oh my God.
Oh, there we go. Okay.
And then you just sit down and talk about all these different things and all the changes we can make to better our environment, better our situation. So that could be a thing.
A beer with your bro, Dr. Yo.
That's right.
Pour myself out a nice pint of stout and we'll have a nice conversation.
All right. Absolutely. We're going to do that next time.
Okay.
We'll record in the afternoon so you can have a beer.
There we go.
Yeah. Bring that up.
Now, this has been fantastic. And one thing that really stuck out to me is that, Johann, I love the fact that, and Kim obviously has been this way through all the podcasts as well. You're very straightforward and you're just speaking truth. Hey, look, the portfolios that our folks are in aren't going to be as high as some of these others that are out there. But you know what? They don't care. And we don't care because of the fact that we're doing better than some other investor that sure, they're going to make a little bit more money, but at the end of the day, they're going to be spending it on gas masks if we keep screwing this planet up, right? So,
Right. Yeah. Well, we're doing well and we're doing good.
yes,
Maybe
absolutely.
we could do better if we were willing to do bad, but I'm not.
I don't know if
Not
that's
worth it.
true. Yeah.
Not-
And I
not
don't think it's true anymore.
I need to make a blog post. There's some people out there right now who are arguing, and it's a long there's a long history of this, right? The argument that, oh, well, if we just invest in the bad things, then we can make more profits.
And donate it.
We can make more profits and do something with it, right? But
Right.
It's actually from book 1 of Plato's Republic. The character of Thrasymachus stands up and says, "Hey, Socrates, don't you know that you can make more profit if you're bad?" And essentially the whole rest of Plato's Republic is a response to that.
It's a tale as old as time.
2,500 years,
Yeah.
they keep trying to make that argument and it keeps not working.
Yeah. All right.
Yeah.
Well, I just want to mention on some upcoming podcasts, I'm planning on having a guest from As You Sow, nonprofit organization that does shareholder advocacy. And Johann and I are planning another conversation, Eric, just so you know.
Nice.
We want to do a conversation between the two of us as if I'm a new client. We have so many people who don't really know what to expect when they come in and meet with Johann. So we're going to give them a sample of that.
Oh, that's exciting. That'll be fantastic because I'll be able to just sit there, listen to you guys, and drink my beer. And
there we go.
Yes.
Yeah, and I can
I
have
will
a
make
few.
sure we schedule it in the afternoon, and I'll have some wine. I'm not a beer drinker,
There you go.
but
No judgment.
Great.
All right.
Thanks. And again, just a reminder, if you are listening and you want to talk about portfolios and how you can make your portfolio cleaner and creating a brighter, better future, email Johann at info@horizonssfs.com.
Perfect. Johann, always a pleasure. So good to see you, my friend. Kim,
Thanks,
thank you, of course, for continuing to bring great content to the audience. And speaking of you, the audience, our last thank yous for you. Thank you so much for tuning in and listening to the Deep Impact Investing Podcast with Kimberly Griego-Kiel. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Kim comes out with a new podcast, it'll show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually does help others find the show. Again, thank you so much for listening today. For everyone at Horizon Sustainable Financial Services, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to Deep Impact Investing with Kimberly Griego-Kiel, the sustainable, responsible impact investing podcast, reminding you that it's time to invest like you give a damn. If you have questions about this podcast or topics you'd like to hear addressed on an upcoming podcast, please email me at kim@griego-kiel.com. That's GRIEGO-KIEL.com. Or give Horizons a call at 505-982-9661 and be sure to ask for Johann Klaassen. Don't forget to click the subscribe button to be notified when new episodes become available, and to share this podcast with colleagues, friends, and family. The companies I may speak about during the podcast are not recommendations for investment. Only you and your financial advisor can determine what the right investments are for you. Kimberly Griego-Kiel produces this podcast on behalf of Horizon Sustainable Financial Services. Horizon Sustainable Financial Services, Inc. is a registered investment advisor registered with the SEC. Horizon Sustainable Financial Services, Inc. and its financial professionals do not render tax or legal advice. The information covered and posted represents the views and opinions of the host and/or guests and does not necessarily represent the views and opinions of Horizon Sustainable Financial Services, Inc. This content has been made available for informational and educational purposes only. This content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning. None of this content may be used or duplicated without the express written agreement of the podcast host.